Welcome to the Hardcore Mortgage Real Estate Business Show, brought to you by Capital Mortgage Funding. We have an unbelievable show. I'm Harvey Free, and our panel is Becky Alley.
What is going on, everybody? It's Halloween weekend. I don't know if you're catching the vibe in the early show if you're watching us live on Facebook, but we had the real, old school Adam West in the studio with us. It was pretty cool.
The real Batman was here. Batman. And of course, we've got our own Batman here, John Cole, Mr. Batman himself.
Kapow, boom, pow. I mean, we talked about this before the show, how much I loved the original Batman. And we all just think about it all the time. And that was just such a great treat.
Yeah, this is when we were talking about, we thought quicksand was going to be more of a factor in our adult life than it was because of the old school Batman.
We are going to talk about some quicksand and some Halloween-themed stuff here. We got Noel Heidemann in, of course, from Christie's at Properties. Hey, Noel, what's happening?
Hey, good morning, guys. How you doing? Yeah, that was really cool with Adam West. Little get up there. That's
the original,
specifically made for him.
Yeah, that's
it's
cool
very
stuff.
authentic. You guys can't see it obviously on the radio, but pretty cool actually see that this morning on a holiday weekend.
That's what this area sort of brings, is those great Halloween vibes. You know, growing up, of course, it's like Halloween never leaves me. And even when I talk to my friends out west in California, they miss coming back here to Michigan, the old Midwest feeling of what Halloween's all about.
Yeah, I mean, crap. I grew up in a family where we would just dress up in costumes just because the Batman premiere was coming out. We would be like the kids showing up as Catwoman and Batman and the Joker, and it was like a normal thing. So I have an arsenal of random costumes that I will sling out at any good time. So.
Well, the good thing is you still fit in those costumes. I think I wore a cape for 5 straight years, even coming home from school. First thing you put on is the cape, Superman, Batman.
Yeah.
Whatever. It's just, that was cool back then.
Yeah, this is a grown man here that had this outfit on too, and it was made for him perfectly. That was cool. Really
We're
cool.
going to tell you why these mortgage rates aren't so scary this time of year. We're definitely going to get into that, of course. 1 hour of the Hardcore Mortgage Show. We talk about mortgages and real estate and anything else you want to talk about related to mortgages or real estate. And, of course, there's title, there's appraisals. We've got, which normally is a slower time, sort of creeping in here a little bit. We'll talk about that window of opportunity. We do it every year. And sure enough, Becky and John, last year we really felt the same thing, Noel. When January 8th, about January 7th or 8th hit, it felt like, hey, whoever wasn't going to buy a house in Thanksgiving or Christmas, they definitely were buying a house January 8th.
Yeah, I mean, we're in a constant, ever-changing environment. And if anyone is, saying otherwise, they're not actually doing real estate right now. I mean, literally from one day to the next, it is changing between if it's at asking, over asking, are you getting concessions? You have some houses that are sitting in the market for over 30 days, but the desirable homes are always going to go fast, and that's not going to change whatsoever. And I always think that this time of year, if someone is serious, right, because everyone's situation is different, this is truly an amazing time to buy, because that's when you kind of start separating yourself and you can get some really good deals out there.
Yeah, absolutely. There's still plenty of properties out there, but we're still, like you said, ever since 2019, we've been dealing basically with the same issue of seller inventory, and there isn't a heck of a lot of it, unfortunately. So it's a cyclical thing here that just continues to feed itself, and we got to bust out of it. Interest rates, like Harvey had mentioned, and I know, there's a possibility of those going up in November. Which affects everybody. But, in the long run, if people want to sell and people want to buy, there are people out there. Unfortunately, I have a lot of people that would love to purchase and haven't sold because they're afraid they're not going to find anything. And the inventory continues to be a big problem.
Right. But there are, like you're saying, there are houses out there, but you're not getting bargains on them like you used to, like back in years ago. My cousin, Sean, if you're listening, this is for you. He tried to put an offer in on a house. I think it was going for $350, and he came in at $260, and the seller was like, "No, come on, get out of here." Just because it had been on the market for 45 days,
right?
And so just because it's on the market for 45 days doesn't mean you're going to get a $50,000, $60,000, $70,000 under asking, right?
It's amazing though. People, you got to take things in perspective, and you got to, think back to different time periods and what has happened and increase in interest rates. It's funny. You see the same thing happen when gas prices go to $5. Everybody freaks out, and then things
there's 75 gas cans.
Yeah, exactly. So it's a little bit of we haven't shaken out of getting, more sellers on the market, unfortunately. Coming up this spring, hopefully, is going to really, really break open the market too. We'll see.
Yeah.
But it's also we still feel that, right? Where when the housing market crashed, and it's still in our DNA right now. We still remember what it felt like. And I feel like a lot of that hesitation is coming from that uncertainty where yeah, you're paying this ridiculous amount in rent, but then people are bringing on that stigma of they're afraid that the housing market's going to crash. And the reality is we're not even in that same environment. We're in a housing crisis. There's not enough inventory out there. So we are going to be in an appreciating market for quite some time because there's just not enough out there, and they didn't build enough, and they're not building enough fast enough. And especially with the rates ever changing, they are the highest they've been since the early 2000s. You can't deny that. But at the same time, if you can adjust your price point to the affordability of that, that's always going to put you in a better position than if you're currently renting.
I'm glad you mentioned that and the proactive steps that are involved in getting the pre-approval and learning a little bit more. Go ahead, John.
Yeah, well, we talked about this on the podcast on Wednesday, how some of these builders are getting away from building single-family residences because the cost of building, they can build an apartment complex for just a little bit more than they can a single-family home and get 2, 3, 4, 5, 10 times the amount of rent because they've got multiple units now. So yeah, single-family homes are hard to come by for new builds because there's just not as much land around. And, we just got to make sure that people are out there and they're informed on what the best is. And like to Becky's point, there is not going to be a housing crash. It's not. That's the mainstream media trying to scare you. It's not going to happen. All the data shows that we're going to we may be stagnant, we may dip down a little bit, but that's not a crash. That's normal cyclical markets.
All right, some cool stuff. Go ahead, Noel.
Yeah, housing prices have not, so if you do in any research, you can just kind of, see numbers and percentages of what happens from say 2009, and you're seeing like 11 to 14% interest, or excuse me, 11% to 14% increase in values, over the, say the last 4 years or so. What I've seen, things aren't necessarily selling in a matter of 24 hours, but if you have a very good property, and it's priced well, it will move in a short period of time. Now, it may not be what it was doing, back in the height of COVID when you were getting 15 offers and $100,000 over list price, depending on what the obviously list price was. But it's not like that anymore. You're seeing some price reductions, a lot of price reductions, but those homes are coming down to the values that they should have been. If you look in totality, our home values are continuing to increase. Now, they're not increasing at that 11 to 14%. But they are still increasing. This is not even close to 2006, 7, 8. Has nothing to do with.
Well, okay, so I even have this in front of me. So in 2006, there was a 2% appreciation, and then 7, 8, 9, you saw that decrease, right? But that's one of 4 times in history that you saw housing market decrease. But in 2022, so we'll go 2020, there was a 10% appreciation in the market as far as like you bought the house yesterday and a year from now, you had that same appreciation. In 2022, it did drop to 6%. So even if you go 3% appreciation, the home buyer that's buying a $300,000 house now is going to be worth $310,000 without them even doing anything this time next year as the home market continues to appreciate because there's not enough inventory for us to see that decline. So when I'm having these conversations with our buyers that are even thinking about throwing their hat in the ring, you have to think about that. That is invisible money. It's not like you can go to the bank. It's it's unrealized. When you're talking to someone, they're like, oh well, why can't I buy this house? I have $400,000 equity in my home. Okay, well, it doesn't work like that until you pull it out, pull out the equity. But the point is that is assets that you have to now elevate yourself to the next home in the future, or pull that equity out, upgrade it, do what you're going to do with it because now you have equity and you can finish your basement or whatever you're going to do.
And when that is realized, it is realized by a certain person right away. And that certain person is the person who didn't buy. So like Becky said, that house that was for $300,000 in 2020 at the end of in 2022 at the end of 2022, the person who didn't buy that house at 6% is now going to buy it for $318,000. So that's the person who gets the realization right away that, oh shoot, I missed the boat.
And the truth is too that even though the interest rates are a little bit higher right now, that same house, even if you're going and the rates drop in a year, you're not going to see that much of difference in the payment because you're going to be overpaying because the competition is going to be there. That's going to drive that overall house price higher.
And of course, you're using national averages here. The appreciation might even be larger in what city you're living in. All right, we got tons to share with you. 248-539-9797. It's the Hardcore Mortgage Real Estate Business Show. Come on back. Alrighty, welcome back to the show. It's the Hardcore Mortgage Real Estate Business Show, brought to you by Capital Mortgage Funding. We're here in our 23rd plus year, coming up on 24 years.
Crazy.
Giving you great information about mortgages and real estate and everything attached. Call us at the office, 1-800-LOW-RATE, the best mortgage banker. Harvey Freed, Becky Haley, John Kolb with Capital. Noel Heidemann, of course, joins us on the real estate side with At Properties. And Noel, tons to share with. Again, we're all local here, which I really like is we talk about this local what's going on here in our backyard. And Becky threw some numbers out there, national averages. But Becky, I would even be strong to say, even in some of our weaker cities here, meaning that they were always first-time home buyers, cities that are up-and-coming cities, even they're seeing larger than 3 and 5%. We're seeing those all appreciated at least 10%.
Yeah, absolutely. And it's a beautiful time for those individuals that got into the market because actually I'm doing a few refinances for those individuals. People think that, oh my gosh, I'm not going to refinance my property because my interest rate is so low. But then a lot of individuals, not all, over the last couple of years, they've got into some financial difficulty. And when you own that property, you can actually use that equity to get yourself out of a bad position if you're in one, because if you're laid off, you've been living on your credit cards. We're saving quite a few people right now, $850 a month. At least I have two of them, me personally, like around $800 to $800. Because the biggest thing right now, we get a lot of calls. Do you do equity loans? Can I get a HELOC? Can I need cash, but I have this really great interest rate, Becky. I don't want to touch it. And then we run the numbers, but what people aren't understanding is that the home equity lines are double digits right now. Because
11.6 I saw yesterday.
Yeah, they're double digits. So when you run the math on if you have a 4% or 3% interest rate on your first and then that 11% on the second, depending on how much cash you're trying to take out, it's sometimes your payment is going to go up in that situation, or you're not going to see that true savings that if you just did one loan. So these are always things that we are constantly dissecting, where you're going, what are you trying to do, what's the end goal in mind as far as what you're looking to do overall structurally. But you can't be locked up with the golden handcuffs of equity. And even if you are in your house right now and it doesn't serve you, there's so many individuals that are just staying put, like you said, because they don't know where they're going, but they're locked up because they're like, I don't want to stay here. This house no longer serves me, but I got this great interest rate, but I don't like this house.
I think what you have to do, and you kind of pointed it out here, you got to vet it. You got to vet it out.
Yeah,
you have to know what your options are. I don't care if you're going to buy in a year. The smartest thing to do is call you guys.
Right.
To get on the right page. Maybe it's your credit, maybe it's who knows what it is. But to get on the right page, to save the money, to prepare yourself as best as you can, I think that's really, really wise. And just know what your options are, because everybody does fixate, and I've heard that so many times, it's crazy about the interest rate, but that gets old at some point
it
too.
Does,
and regardless of what the interest rates are, kids grow, families grow, they grow out of houses, they downsize, upsize, whatever. It's going to happen. It's just part of life.
Right. And I just took a call the other day where they weren't looking to move for another 12 to 18 months, but they had a ton, like Becky's saying, they had a ton of credit card debt. I'm not going to lose my interest rate at 3% until I move. When I sell my house, then I'll pay off my credit card debt. And I was like, do you know how much money you're going to lose in the next 12 to 18 months by doing this? Let me run the numbers for you so you can see if you pay off your credit card debt now, yes, you're going to lose that 3 to 4% interest rate, and you may be closer to 8. But here's what you're saving on a monthly basis. And you're saving that for the next so many months,
12 months or whatever it might be. Yeah.
Now all of a sudden you have the same amount of debt, right? Because we have the mortgage and the credit card, so it's now on the mortgage. So it's the same amount of debt. The total debt is the same. The house is being paid down, but you're putting $600-700 a month into your pocket for the next 12 to 18 months. I mean, you're talking about another 10 grand, 12 grand. That's in your savings now that you wouldn't have had.
John, $500 a month savings at 12 months, that's $6,000. I mean, it adds up quickly, and you're in the same position you are when you go to sell.
Right. Yeah. And you're in the same position as you were, but now you've got money in the bank.
Yeah. And you can put that, even when you run the numbers, like with the individual that I'm working with, even if they put half of what we're saving in the bank and half on the principal, they're literally going to be debt and mortgage free in 10 years.
Right.
I mean, but you don't know that unless you're having the conversations. The conversations that we have are absolutely free. So if you're talking to someone, they want to collect something from you over the phone as far as a payment, just to have a conversation or hold a temporary appraisal money, just kindly exit that conversation, because that's not someone that you want to be in line with, because whether it's 5 minutes, 5 months, 5 years from now, the conversation that you're having with us is always going to be the same.
Yeah, deal with the experts for sure. 248-539-9797. We're talking about all these Americans and all their numbers. Americans say that their household expenses has risen in the last year. You definitely know that. About 8 in 10 Americans say their overall household debt is higher or about the same as it was last year. And only half of them are really feeling that good feeling, because you're sitting there, let's see, 3 in 10 Americans have foregone that purchase. So it's scary out there. Again, the cost of gas, the cost of groceries, the restaurants, the appliances, whatever you might lay your hands on. And here locally in, of course, Michigan, the automotive capital of the world, car payments have gone up. Of course, the pinch on the Fed funds rates going up. We really see it specifically, of course, in mortgages, as rates have doubled or even tripled, but more specifically, even car loans. Man, you want to go get a car now, Noel, it's going to cost you a pretty penny.
But people don't even hesitate about that. That's what blows my mind is there's a lot of individuals out there where they will have their credit pulled time and time again over their lease or getting a car, and they're paying these really double-digit high interest rates on these car loans. They don't even think about it, but they hesitate about having a mortgage credit pull. Like, I don't know. It might affect my credit.
I don't want it to hurt my credit.
They with a credit card. So I just need everyone to hear me, okay? A mortgage inquiry is completely different than a credit card inquiry, even a car loan inquiry. You have 45 days, and it doesn't even really affect your credit for 30 days, but you have 45 days to have, I would say, no more than 3 people pull your credit. It's totally different. It's the most nominal, minuscule thing that's going to affect your credit. And the reality is what affects someone's credit is missing payments, overextending your credit. Those are the things that are really going to have the most detrimental effect, not a mortgage inquiry. So I don't recommend having any more than that pulled, but because then you just muddy the water and someone's going to tell you what you want to hear and it's bad.
But we can, at Capital, we can still do a soft pull too, where it doesn't even affect your credit at all. And, you aren't notified by the millions of banks
bottom
out there,
feeders.
that are going to buy the leads and then call you on your work phone 7 times a day. It's just ridiculous what they do. And I mean, thank God that we are not a company that is part of those trigger leads that Experian, TransUnion, and Equifax sell. They sell the lead of someone pulling your credit to other mortgage companies. I think it's just wrong.
That's where the new people in the industry, that's where like you said, a little bottom feeding going on out there. They're unqualified to really speak about experiences. They just haven't gone through it. They haven't been around for the time that it takes to really develop these skills and see what goes on in the mortgage world again. So get with those true professionals.
Yeah, exactly. You've got to go talk to Capital Mortgage. That's what you got to do.
Talk to somebody.
I mean, yep, you really do.
248-539-9797. We want to hear from you this morning, too. All right, Noel, let's talk about what's going on here locally in our backyard. Yes. Is there a window of opportunity? I keep telling folks this has been going on for about really 3 years here. Yeah. We already know home values are going up. Supply and demand is taking over. Is there that window of opportunity? You said there's not 10 offers on the house. Maybe there's 5. Yeah. So again, if you're looking at that house, put that strong offer together.
Yeah, absolutely. And some of the things like Becky was talking about earlier and John, there is a mentality. I just a couple of weeks ago sold something in Rochester, and it's interesting. It's a great house, 8 years old, 7 years old. I got multiple offers, and one of them was very, very low. And it's funny how when I'm getting these offers now and agents are already trying to justify why they're doing what they're doing, and they're telling me all the wrong things of what's wrong with a house instead of all the good things that want to sell it. And I'm kind of thinking to myself, in this market, you're really hurting yourself by doing that, by you telling me that this needs this and this needs that. And it's multiple houses that this happens with. But, it's all about presentation and who, obviously, there isn't a lot of great houses out there. Unfortunately, there's not a lot of inventory for the people to pick from. So when you do have a buyer, you do have a seller, you do want to be not picky about the purchase agreements, but obviously you want to get something solid. But there's just not a lot out there. And I think a lot of people have taken kind of a back seat and have just waiting it out to see if there's more properties out there. There's a lot of great houses out there still. And you're starting to see a little bit more, price reductions. And it's not because the value is not there. It's because the people started out way
it's
too
overpriced.
High.
Yes.
And they still have the mentality of 2 years ago where, hey, I put it up for whatever, and I'm going to get, way over that.
So in those situations,
not realistic.
Is it if they're overpriced and you see these price reductions, so people think they're getting a deal now, all that, right? It's like, if you go to like major retailer, they're like everything's 0.5% off, but really they jack up the price, right? But anyway, so are you finding that in those situations, it is the agents that are possibly like being forced to list it higher based off what the client is pushing for them? Because I know you guys have to do what your client wants.
Yeah,
Even if they want to offer 50,000 over and it's almost 50,000 under, it's almost insulting.
Yeah.
You still have to write it because that's what they want.
It's an interesting conversation that you have with sellers because you always want to be open to obviously their perspective, but you have to remember that you are the professional. You do this. I've been selling real estate for 30 years, so you do know a little bit about what you're doing. But in this market, it's very, very interesting to see what is happening and what isn't. And you think, sometimes even, you got a great house up. I've got something up, for example, in Detroit up for lease, and it's great building on Trumbull. And in 2 weeks now, I've not had anybody even go look at it. And it's a lease, which is really surprising. But that's just kind of, where we're at right now in this real estate market. So there is a lot of great properties still out there. It's interesting. People think when you see price reductions and you see multiple price reductions on a house, people think what's wrong?
Yeah,
it's just
something's
human
gotta be
nature.
wrong, right?
What's wrong? The foundation, whatever, who knows? And it's not that at all if you actually do your research, or it could be, but it may not be that at all. It's just that people started way too high.
Yeah, I agree with that. I actually even have one. I mean, on the other side of things, I have a transaction and there was an appraisal done that no one knew about in July, right? So we had an FHA. So if you're doing an FHA transaction, that appraisal is attached to the property. So originally we were starting off with our buyer as an FHA transaction. Well, it comes out that this appraisal was attached to the property for $138,000. Our sales price is $170,000. I mean, that's like, but nobody knew. The listing agent didn't disclose that. The buyer's agent obviously would have had no idea. And then we find out because we find out everything. So don't hide anything from your lender. We're going to find it out.
Right.
But after looking,
Becky, you're like Batman.
yes, we're going to find it out. But fast forward, I was able to convert that buyer to a conventional loan and the house just came in at purchase price. I mean, you're talking that is a $40,000 difference in just 3 months.
Don't wait. 248-539-9797. When we come back, all of your calls. All righty, welcome back to the show. It's the Hardcore Mortgage Real Estate Business Show, October 28th. We had a Halloween weekend going on here, and I'll tell you, this is a Halloween state. Go out there and enjoy yourself. Be careful. Don't overdrink and drive and do all that bad stuff. A lot of people out with the nicer weather, so be very careful out there. Again, safety is what we concern ourselves with. That's the most important thing, that you're able to buy a house in the future with us. And, of course, we got Noel Heidemann here, always behind the scenes talking about different things about mortgages and real estate. Hey, we brought it up. Why not talk about it on the air a little bit? These property inspection waivers. Yeah, sometimes we get them, Noel.
Yeah.
We punch the information in the computer, as John Kolb was just explaining. Back in about, what you say, John, about 2012, when Fannie and Freddie started logging in all the information. So if a house was sold and the appraisal came in at 300, that was logged in. So now there's an algorithm, and they can sort of determine what the house might sell for in today's marketplace.
Right. I mean, back in, like Harvey said, that 2012, they opened up the portals. Anytime you did any financing on a home that required an appraisal, you had to upload the value to both Fannie and Freddie's portals. It just gives them an idea of where the house would be worth based upon ups and downs in the market, where that house would be worth in 2023. And so that then will give us an idea of whether or not we need an appraisal on the property. But in conjunction with the value there or not, what also it couples it with how much are you putting it down on the home? What's your credit like? What's your debt to income ratio? So all the stars and moons have to line up for the client. It's not going to be a 5% down purchase, doesn't need an appraisal. It's the 20% down with good credit and good debt to income ratio that may not need it if the house has been financed in the last number of years.
What would you guys say is the percentage of houses that you have or clients that come through that get in, the waivers?
Well, the question then starts with, what is the percentage of clients that come through that are putting 20% down? Right.
Okay.
So, if they're putting 20% down, I would say that if they've got good credit, you're going to get a PIW. If that home has been financed in the last couple of years, you're going to get a PIW probably 5 out of 10 times.
No, at the end of the day, though, it's really just, so there's no appraisal done. So then we don't have to tinker with the value. So it's a pretty much a done deal. But a lot of families still have that choice, though. Do they want an appraisal done?
Some people still want that
they
appraisal.
Still want it. Yeah, go explain that a little.
Well, they want, because they want to know what they don't want to overpay for the house, right? So if they come in over asking in a situation and they feel like if they don't do an appraisal guarantee, meaning that if the appraisal comes in lower, they're not on the hook for that extra sum, it gives them an opportunity to turn around and renegotiate. So sometimes people will request that appraisal, even though they have that PIW option where they don't need to go forward with an actual appraisal inspection. But more times than not, they're gonna go on the option of not having to deal with that, because if you have a house under contract, you want to eliminate any risk factor of anything throwing a wrench in your in your sales, right? Because an appraisal is someone's opinion of your home. I could go out there, and John could go out there, and Harvey could go out there, and you can get 3 different numbers. I mean, there is formulas, but it's also, at the end of the day, it's someone's opinion of that home, because you can't take the people out of the industry.
Yeah. Right before the break, Brecky was talking about one that came in at 138, and a couple months later it came in at 170. That's a perfect example of what
Correct.
she's talking about. That was someone's opinion, and it may have been a bad appraisal.
It was. I saw it.
Yep. So that appraiser did not do a good job, and then months later, then a different appraiser walks through and says, "No, this can definitely work out." And so, it's an art, not a science.
Yeah, and I didn't get a chance to wrap that up. So when I was talking about that different appraisal, I saw the value, I saw the comps, and in comparison to what I asked them to provide me, like, well, where are we getting this value? And I had to have a very deep conversation with the buyer, because our job is to ensure that our people are not overpaying for a home, but we're also not walking away from a transaction that is skewed by someone else's opinion. So we had a good conversation. I said, we can go this direction with it. Let's try it. If it comes in low, everyone was on the same page. And it actually came in above the purchase price in her situation. So now she has about $10,000 in equity. But all that started from, when you're working with professionals that can identify these things, know how to read an appraisal report, can identify when someone has not done their due diligence and they were being a little bit skewed on the value and the comparables. I mean, it just was not a good appraisal. And sometimes it happens, sometimes it doesn't, but it was worth us trying to go that direction, because this was the dream home for her and her kids. And they've been looking at houses for about 6-7 months now, and this was the one, and they wanted me to take a shot at it, and we did.
There you go. Hey, Noel, what's going on with these offers? You need a strong agent out there. We're going to talk about that, but painting a picture of who you are, the old love letters. I love your house.
Yeah.
We hear they still work once in a while. Some people won't even take them. They want highest and best.
Some agents don't even supply them to their clients.
I've had that happen too.
You're pulling at the heartstrings a little bit here of the sellers. There's no doubt that someone who's lived in the house for a long period of time and might have raised their family. And no, you work in that you've always been a Birmingham Royal Oak guy in the corridor, Woodward corridor. So a lot of the older folks there that have lived there and raised their families, they are really sentimental about the house. And there is a small possibility that if they had an offer and it came with a love letter and it was a family attached, there's a small possibility that still works, or you just need a strong agent and throw that out.
I think this day and age, it's very, very important to have a good relationship with the people that you work with. Not only you guys at your office, but me, and we're all independent contractors as realtors. So having relationships and good relationships with our associates who we work with and our colleagues throughout the industry is really, really important. More important than a lot of things, believe it or not.
That's number one in my book.
If you have a track history of working with people and doing a good job, being honest and fair to both parties, and understanding what the end goal is, I think is really, really important. Values and it's interesting about, and I had brought up the question to everybody at the break, about these appraisals and when you get appraisal value or waivers and whatnot. The real estate industry is very, very interesting. For the last 30 years, I don't think I've worked a day in my life. And the reason being is that we're all different. Everybody's motivation's different. One might be financial, one might be emotional, one might be family, one might be this, one might be that. So when it comes to not only listing property, but selling property and coming up with numbers and prices, yes, we do, break down numbers and you can see what, things have happened in the past, say 6 months or a year or whatever. Really, we've been going back a year. In the last couple of years, I've been looking back a year just because of what the values have been doing. But, getting a true value on that and then putting it on paper, and then taking it to, if it did need an appraisal, I've had to fight quite a few of them in the last few years. Just because, the ridiculousness of what's happened with property values and how fast things have increased, that's a big difference I've seen now versus, say, in the last few years. It's just the frenzy is not there. And that frenzy was not healthy. That the interest rates at 3% and 2.5%, as far as I'm concerned, are not healthy for a real estate market. And we have to work our way out of that. And it will, and we will, and it'll take time.
Yeah, no one's really bragging about when they paid $100,000 over asking in 2020, because I've seen it. People were doing it. They wanted to win, but they got that great interest rate.
But now the house is worth more too.
Yeah,
right?
now it is. Yeah, so it's all about that number. So they rolled the dice, and now they have that equity in there, right? I bought a house in 2018, and my house is worth double. That's
a catch-22 too. So you got to remember. Okay, so you're talking about interest rates, and they're 3%. Okay, and say they paid $100,000 over a house that was, I don't know, $800,000, whatever it is, right? What is the difference if that interest rate was 7% and they didn't pay over $100,000 cash out of their pocket?
Oh, they'd be paying more.
Yeah.
They'd be paying more right now for lesser purchase price, higher interest rate.
Right.
Because that higher interest rate's on the majority of the loan, right? Versus the small amount of the $100,000 on 3. So yeah, it's a no-brainer. You don't even have to run the numbers. You're going to be paying much, much more.
248-539-9797. We have some open lines. I'll always love to hear from you. Again, if you're thinking about refinancing, doing a cash-out refinance, call the experts. Let us do the numbers for you first. We'll get you set up for success.
What's the number at the office, Harv?
At the office, 1-800-LOW-RATE. That's easy enough right here locally. If you're calling in Michigan, 1-800-LOW-RATE. That's 1-800-569-7283. And, of course, you'll get us on
248-569-7283.
Got all those numbers.
It depends on, if you want to dial 1-800 anymore. Does anyone, who cares about minutes anymore? It's toll-free calls.
Yeah, but it's easy. It's easy,
Can't forget it.
No.
Except for Noel. Noel's still got a rotary dial cell phone.
Right.
So.
Well, and a flip phone.
Remember when you called grandma to get the time? Dial grandma and it would the time is at the tone.
Oh, yeah. Dude, what was it, 555?
I don't know. Whatever grandma is on the dial, be like, what time is it, grandma?
And they're talking about Batman at the beginning of the show, too.
Yeah, we're all dating ourselves.
It must be Halloween.
I brought in some statistics, and it showed us that September, believe it or not, was 33% higher. This September of 2023 was higher than last year, 2022, in sales sales and the amount of sales. So there are buyers out there, and they're going to make the moves, Noel. So I think we're going to have a huge 2024.
I think so, too.
It appears that way, and that's why we continue to sort of reach out to as many families and individuals thinking about home ownership. Make that initial call, because we do find there's always that window, that Thanksgiving, Christmas window, where there's just a few less buyers out there, and you might be able to set yourself up for success. 248-539-9797 if you want to give us a call. Becky, of course, FHA loans, the loan limit went up on the conventional side, so we definitely want to share that information. They're going to be looking at $750,000 for the new conforming loan limit. So, Becky, I did the math before on the 65% of that. John Colby, you might do it. FHA loan limits up to like $475. John, would you do the math for me? 65% is $750 is the new FHA loan limit. $487,500. So if you had some blemishes on your credit in the past, a foreclosure, a bankruptcy, low credit scores, you can still get into that house.
Yeah, this is a no judgment free zone. So everyone financial picture is totally different, and how you're getting where you're going is going to be completely different than someone's friend. So you can't get caught up in what your cousin's brother and sister's cousin's dog did. It's got to be about you. So what we're talking about is that, you can buy more house, and so if you had a blemish on your credit. So if you had a bankruptcy in the last 2 years, you make really good money. You just got in a tough spot because the last couple of years were tough for a lot of people. You can still purchase a home in the $400,000 plus for FHA, and you don't have to put more money down.
Right. And for the naysayers out there saying that there's going to be a housing crash, those economists, the economists with the Fed, with the Fannie Mae and Freddie Mac they're not the Fed. The Fed can't do anything right now, but the economists with Fannie and Freddie are projecting values, loan amounts to go up in our area. So that means we're going to be pretty stagnant and or increasing in value. We're not going to have a housing crash.
Yeah, you're looking at it. If you're so inclined and you're in that price bucket, if you can buy a $750,000 house and put 5% down, that is amazing, because even just last year, you're looking at, probably having to put at least 10 to 15% down, because that would be considered jumbo financing. And there's there's more strict underwriting guidelines when it comes to that. We've also talked about the multi-unit, right? That's huge right now. A lot of individuals are looking for those multi-units, 2 units, 4 units. You can now do those with 5% down if you're going to occupy one of those units. And even if you're doing a 4-unit FHA, it's more difficult, because not only do you have to qualify, but the property has to qualify. So now with conventional, 5% down, you occupy one, you rent the other 3 out, you're a freaking real estate mogul. Go you.
All right, it's a Hardcore Mortgage Real Estate and Business Show. Come on back and join us. 248-539-9797. Keep it here. We are back. Boy, that was quick. 9:44 if you're just joining us. Cooling off outside. Definitely falls in the air. We got Halloween here, Becky. A lot of fun coming up Tuesday. And, of course, always wishing that everyone watches themselves. Be safe out there. Hey, if you want to talk about mortgages or real estate, come and join our show. We've got Noel Heidemann, and, of course, from Christie's and at Properties.
I want to give a shout out real quick to a longtime client of mine, Bill Vandement. He just shot me a picture. So we bought, he did a condo. We did his condo in Florida. So he just purchased it.
Okay.
He just sent me a picture of a beautiful view. So congratulations to Bill. And he's actually listening to us in Florida. So in case you don't know,
fantastic.
we are a national lender. So we are in all 50 states. We're all licensed in multiple states. So we kind of look at it as we go where you grow. So it's always a beautiful thing when I got my boy in Florida and he's still listening to us here in Michigan. You know, it's kind of like all one cohesive family. It's pretty cool.
Yeah, I actually have a license in Florida. I think we all are licensed in Florida too. One of the hot, spots, of course, one of the hot states here in Michigan. A lot of Michiganders get down there and definitely check it out. I'm an expert on that side of town because I've been going down there for 30 years. And I got to tell you, the best mortgage people are here in Michigan. So if you're thinking about buying that vacation home, deal with your lenders up here. And just if you're a national lender like Capital Mortgage Funding, you can reach out again, 1-800-LOW-RATE, and get one of us professionals on the phone, and we'll talk all about that. State, John, you do California, and of course, I'm not licensed in California. You're able to hook up a client. That was like a 3-week closing. So congratulations.
15 states I'm licensed in right now. So it's great. I mean, it gives you a lot of opportunities. I mean, it's a lot of training each year. Becky and I both know that you got to go through a lot of continuing ed each year to do that, but that's the time and effort that we put in to make sure that we can service our clients across the nation.
No, what about these D's here? These D's that always affect our industry. There's death. Oh, that's a bad one. Divorce, downsizing. Hey, that's a new D. And distance. So the distance is from work to home. And these are the 4 D's and reasons why a family might be getting out of that house that's worked so great for their family, and now they've got to move on.
Absolutely, yeah. I mean, there's lots of different, things that happen with people, and the distance, it's crazy. I don't know. I'm dating somebody that lives in Fenton. And,
that's not that far.
I know it's not. It's 50 miles, but
you just got to get into a trance.
The construction,
what we call that
in Oakland County is absolutely ridiculous.
Construction is really bad.
So
John, I know where you're
50 miles. That's a dud.
I
geographically
hear that
undesirable.
I hear that a ton from clients about getting to and from, and that does play a factor. But that's part of where we live too. We're in Michigan. It's going to snow. We're going to have certainly construction traffic, from April through November. And that's just a reality.
Are you seeing a lot of buyers selling that bought during over the last 2 year, we'll say 2020, 2021, thinking they weren't going to have to go back to work, and now they've bought a little bit further out? Are you seeing some people relocating for those reasons?
I haven't myself personally, but I know that a lot of people have. COVID did a lot of things to a lot of companies, and obviously a lot of people's schedules and people with kids, and as everyone knows out there in radio world, that we had to adapt and we had to adjust. I have seen a lot of people that went home and now are going back, and that's more, I think, changing their schedules in regard to the kids and just their daily lives more than it is necessarily the households. But then again, those kids are getting older and older. So I have seen, some people, make the transition because of that. Not a ton. But I think that's becoming more and more a reality. If you look at the neighborhoods that are, farther north, farther west, you're getting more for your money. Oakland County, is just very, very expensive. So the farther out you go, obviously, the more you get for your money. But then then you add the travel.
Mm-hmm.
Right. I had read that in an article that more and more second homes were being sold back and or going under because people bought them thinking that they were going to be able to use those homes and stay in them and work from them no matter what. And now their companies are requiring them to be back in the office more often. And these people don't want the second home anymore and or can't afford it anymore. So,
yeah, you saw a lot of people walking away from second, third homes back in 2006, 7, and 8. That's the first thing that went. Yeah. They just walked away because they couldn't afford it, everything,
But that's also why when you're buying multiple homes, that's why there are more rigorous underwriting guidelines. It was where if you were buying a second home, you could put 10% down. That was the minimum requirement, and the interest rate would mirror that of a primary home because, a second home is defined as occupying it some of the time, right? So like end quotes, air quotes, right? But people were Airbnb-ing it. They were they were getting income off these properties, and they caught on to that. So now they've changed it where you still can get 10% down, but now these interest rates mirror that of investment properties. So you're definitely in the 8s on a second home right now. So if you can afford a second home, you have to be able to afford a second home. Like you can't just breeze by. You have to be financially responsible. You have to be able to maintain both properties. And you got to have that extra 10% down. And because that's always the first thing that people are going to be walking away from. So everything that a lender does, whether it's us or anybody else that's doing a mortgage, everything is to prevent that home from going under or being lost to foreclosure. Because and all these mortgages that are out there right now, they are well qualified mortgages. You don't just get mortgages. Now they're loosening some of the guidelines, but at the end of the day, everyone is well qualified, and majority of the individuals out there have at least 40% equity that have owned their homes in the last 5 years.
They're not walking away, Becky.
Yeah,
that's
no,
for sure.
absolutely not.
They're not walking away. And I think it's knowledge, it's knowing, it's talking to you guys, talking to people, educated finance people like you guys at Capital Mortgage Funding that know what you're talking about and get the whole picture. And once you have that, I think you're much more comfortable, obviously, making any decision. But know where your options are.
Yeah.
And know what the pros and cons are, et cetera. And then
you said options, didn't you? There's many of them available. You got to find the right mortgage. That's
it almost
for
would
sure.
make someone's head explode.
Yeah.
The amount of programs and scenarios that can be ran, and that's where, like, you're really great at finding that. Okay, these are the top 5, but let me narrow it down. So, what is going to be the best position for you?
Undeniably, purchasing a house can be pretty tough, and especially if you don't have these tools. So get with those basic tools. I like that. The alternative to buying a house out there that's listed by a complete stranger and dealing with a real estate agent is buying one that's right under your own nose. It could be a family member's house. And Becky, you and I know that we handle many of those transactions, setting families up for home, really for the best way to purchase their house with keeping the money in their pocket. Again, you could be a mom, a dad out there. You want to sell the house to one of your kids. We can show you how to do that. Maybe if we set it up properly, they don't need to come out of pocket for anything. I've got one of those going on right now, and it's so fun to work a transaction like that, especially now we see what the appraisal came in at, and there's so much equity. So again, you can buy a family member's house. You better have a great mortgage person to set that all up for you, because we know how to set it up where it's going to save you a ton of money.
This year I probably was a part of more of family transactions in my career, to be honest with you. There's quite a few. And it also adds to the inventory being skewed, because you have a lot of house swapping going on right now where brother's selling to brother, then the other brother's buying grandma's house, and then grandma's like going into senior living because she's, sick of being lonely and she wants to go play checkers with all of her friends, and it's and everyone's happy, right? But you have to know what you're doing too at the same time, because in those situations sometimes they do want to cut out the real estate agent. Yeah. And if you're with a mortgage lender that doesn't really know how to guide that, you're going to get into some serious issues. You can give someone your equity, but how that has to be structured is very specific. And a lot of these situations, I know, John, you're the same way. We still do suggest that there is a real estate agent acting as a transaction coordinator, because there are moving parts that as a lender, we don't want to really get involved with, like the city inspections and the closing being scheduled, and all that stuff is kind of, we deal with it a lot, but there's a lot of nuances that the real estate agent still can help on a for sale by owner.
Even just the realtor being part of the transaction also is the second eyes and ears on to make sure that when you just sell family to family, there's a chance that you might not have to pay any transfer taxes. And that saves the seller, what is it, $860 per 100,000.
You have to pay the state, but not the county, or you have to pay the county and not the state on the transfer tax. I forget which one it is.
And also, there's a chance that you don't have to uncap the property. So the property taxes don't have to be uncapped. Yeah. And you can continue with how grandma or your parents were paying on the property taxes without having to get it reassessed. So more eyes and ears on the situation with knowledgeable people is going to make you successful, because everybody's going to make a mistake. We all make mistakes. And the title company could miss that, where if you file the wrong forms after the purchase and they reassess the property or hit you with the transfer tax, you're not getting that money back.
No, a couple minutes left. Let's go there real quick. Families were waiving the inspection. Then we moved on to pass and fail. Let me tell you another reason why you make it a pass-fail inspection. Learn the functionality of the home. Yeah. It's so important, and I think so many families did miss out on that little piece. Again, it wasn't you were doing an inspection to chop off the legs of the seller after you had the deal. Yeah. It's really, truly to learn what's going on with the house. What's it going to cost me in the future to keep this house cleaned up, fixed up, and functioning the proper way.
Well, right. And I mean, if you're a first time buyer, it's incredibly, important and helpful. And I have never recommended that people not do a home inspection. This market in the last few years, you're seeing things that you've never seen before. And I'm very happy that we're moving away from that, quite frankly, because it's just unrealistic. It's not healthy. It's not good for anybody to have a market increase the way it does. And it's just not a healthy real estate market. But things are, pointing in the right direction with interest rates. Who knows what's going to happen with those if they pop up a tick? But
if they bump it, it's already built in.
Yeah, exactly.
I think we're maxed out for the year.
Yeah,
on interest rates.
The truth though is that the average consumer is concerned. I mean, you have higher prices, you have higher interest rates, groceries, everything is more right now, more. But even rent is up, so you have to make that decision, right? Where are you going?
I just talked to someone in Texas. Their rent was being increased $900 a month.
That's the most important part about again, if you're going to purchase or if you're looking to sell, then you're probably going to buy something more than likely. But if you're looking to purchase, it's so important to talk to, like people at Capital Mortgage Funding who are professionals that will like set you up so you know what your options are, your best options are, whatever the loan is. Gosh, FHA is up to $487.5 now.
Isn't that great?
Holy cow! I think it was like $50 when I started in this industry. So it's amazing.
Yeah.
I mean, almost $500,000.
Or even like when it went up to 315, we're like, oh my God.
I know, exactly. That's amazing.
We're towards the end of the show, John. We did some math, and I want to share the math real quickly. So we started the year around 6% on a $100,000 30-year mortgage versus 8% today. I think we did the math quickly. $134 between that two. Yeah, it was.
No.
I corrected it with you.
$134.
From
6% to
8%?
8% was like $200 and almost $300 a month.
Did you do that math?
Yes,
I thought it was 134.
No, you were
All right,
wrong.
we got more math to do. Call us so we can cram some numbers for you for sure. No doubt, John. If we're going to buy a house at the beginning of the year, get that strong approval letter. Becky, we see it often. We're getting a lot of referrals from our quality real estate agents out there. Sometimes we hear the clients are already pre-approved. When we speak to them, they haven't submitted documents.
They're not really pre-approved. There's a lot of noise out there. You have to be vetted buyer. You have to be strong. You got to get your pay stubs in, your bank statements. Everything needs to be done. There's a lot of people out there running around with pieces of paper, and once they get under contract, it's falling apart because they didn't have the right conversations with the right people.
All right, that music says we got to wrap it up here. Keep it on 97.1 The Ticket. There's sports all day long. We see Pat Caputo. He's coming in here. We will see you next Saturday.